Okay, let's try and unpack what could be a really pivotal moment for Bitcoin. May 30th, 2025 is looming, and with it comes the expiry of just a massive, what is it, $13.8 billion in Bitcoin options.
Yeah. Huge number.
Kind of feels like a high-stakes poker game reaching its final hand.
Yeah.
A huge amount of money on the table, all based on where Bitcoin's price actually lands.
Absolutely. And what's, well, particularly noteworthy isn't just the colossal sum involved, but the potential ripple effects this expiry could have across the whole market. To break it down simply, a Bitcoin option gives you the right, but not the obligation, to buy. That's a call option, basically a bet on the price rising, or sell, that's a put option, betting on a price drop Bitcoin at a specific price by this date, May 30th.
Exactly. And we've got our hands on some pretty fascinating analysis zeroing in on this specific event. So our mission today is really to cut through the noise and understand what this, $13.8 billion expiry means, especially with all the buzz around Bitcoin maybe hitting $110,000.
Yeah.
What are the key forces at play here?
Well, let's dive straight into that $110,000 target then. The analysis highlights that Bitcoin bulls seem laser-focused on hitting that level by May 30th. And it's not some arbitrary number. It's the point where a really significant chunk, around $4.8 billion of these call options, would become extremely profitable. What's particularly interesting about this $4.8 billion isn't just the amount, but how concentrated it is at that specific strike price. It sort of suggests a potential magnet effect, where traders might actively try to push the price to trigger those payouts. Could create more volatility than if the strikes were more spread out.
That makes sense. Yeah, a big payday all focused on one point could definitely incentivize some aggressive moves. And you can see why the bulls might be feeling confident. We've seen that pretty impressive 25% surge in Bitcoin's price just over the last month.
Yeah.
That definitely caught a few bears off guard.
Yeah, that recent price action is crucial context. Now, let's look at the bigger picture of these options. Like we said, the total open interest is $13.8 billion. Open interest is a key term here. It basically just means the total number of outstanding options or futures contracts that haven't been, exercised, expired, or offset yet. So of that total, about $6.5 billion is in put options. Those are the bets that the price will go down. But here's where the current market sentiment really comes into focus. The vast majority, around 95%, of those put options have a strike price below $109,000.
Wow, okay. So almost all the put options are betting on a price way below where we are now. That really paints a picture of the prevailing confidence. So if Bitcoin just stays near its current level, we're definitely above $109,000, less than $350 million worth of those put options will actually be in the money when they expire. Very little.
Precisely. It indicates that a huge segment of those who bought sort of downside protection just didn't anticipate Bitcoin holding these higher levels. On the flip side, you've got about $3.8 billion in call options with strike prices up to $109,000. Now, it's important to remember, though, that not everyone holding a call option is necessarily just making a straightforward bet on a massive price increase. There are more nuanced strategies at play.
Right, like those short call and bull call spread strategies. We've seen some activity in those on Deribit recently, haven't we? Can you give us a bit more insight into why someone might use those?
Certainly. So a short call strategy, it's often used by people who expect maybe sideways or just slightly upward price movement. They want to generate income from the premium they get by selling the call option. They essentially profit as long as the price doesn't go, significantly above the strike price they sold at. A bull call spread, on the other hand, is a way to express a bullish view, but also limit both the potential profit and the potential loss. It involves buying a call option at a lower strike price and selling another call option at a higher strike price. It's a more controlled way to play a potential price rise.
Interesting. So while there's a substantial amount of call options out there, it's not all just like pure bullish speculation aiming for the moon. But the underlying implication still seems to be if Bitcoin can hold that $109,000 level, many of these bullish leaning strategies should turn out profitable at expiry. What's been the fuel for this recent bullish fire then? What's pushing it?
Well, the analysis points pretty strongly to significant net inflows into the U.S. spot Bitcoin ETFs, especially between May 20th and 22nd, a staggering $1.9 billion flowed in. This indicates very strong institutional demand for Bitcoin, even above that $105,000 mark.
Yeah.
When large players are buying in at these levels, it tends to create a strong support floor, make a big price correction less likely, at least in the short term.
That kind of institutional backing certainly carries weight, but of course the market never moves in just one direction. What kind of tactics might the bears be thinking about as we get closer to this expiry date?
Well, the analysis suggests that bears might try to influence the BTC futures markets to try and cap their potential losses on those put options that are way out of the money. The total open interest in Bitcoin futures is considerable, around $79 billion, and there's evidence of strong demand for short positions traders betting on the price of futures going down.
Okay, so they might try to exert some downward pressure through the futures market. But the analysis also highlights that this strategy could backfire quite spectacularly, right?
Absolutely. It's a real risk for them. If Bitcoin's upward momentum continues and it breaks decisively above that $110,000 level, those bears holding short positions in the futures market could be forced to rapidly close them out to limit their mounting losses.
Right.
And this forced buying could trigger what's called a short squeeze, potentially just accelerating Bitcoin's price even higher.
So it's a real tug-of-war playing out here. Now, the analysis also brings up a crucial external factor: the broader macroeconomic environment, and specifically the potential impact of U.S. tariff threats. How could this kind of outside influence derail the bullish story?
Yeah, that's a critical consideration. While the options market dynamics give us a fascinating glimpse into near-term expectations, broader economic uncertainties can always overshadow these technical factors. The bears' primary hope at this stage might indeed lie in a weakening macroeconomic outlook. Increased risk aversion, maybe stemming from economic instability, could lead investors to reduce their exposure to more volatile assets like Bitcoin.
Makes sense.
And as the analysis points out, these tariff threats that have been floated, they introduce a significant element of economic anxiety that could certainly disrupt the current bullish sentiment. The continuation of this upward trend is, well, very much contingent on developments in this potential tariff war.
Right, so it's not just about the internal market forces. The whole global economic backdrop plays a vital role. Okay, so the analysis then outlines 4 potential price scenarios around the May 30th expiry. Let's walk through those and see how the balance of power shifts in each one.
Certainly. First scenario, if Bitcoin settles between, say, $102,000 and $105,000, in that case, the estimated value of in-the-money call options is around $2.75 billion, compared to about $900 million for put options. So that gives a net advantage of roughly $1.85 billion to the call holders.
Okay, $1.85 billion favoring calls. Got it.
Yeah.
Moving up the scale then, if the price lands between $105,000 and $107,000.
Then the in-the-money calls increase to roughly $3.3 billion, while the puts drop down to $650 million. This increases the net favorability for calls to $2.65 billion.
Advantage growing.
And if Bitcoin manages to climb into the $107,000 to $110,000 range, the value of in-the-money calls rises further to about $3.7 billion, with puts now at a mere $350 million. That results in a net favorability for calls of $3.35 billion.
Again, pretty significant now. Finally, the scenario the bulls are really, really hoping for. If Bitcoin pushes between $110,000 and $114,000, what happens then?
Right. This is the big one for them. In this range, the in-the-money call options explode to a staggering $4.8 billion.
Wow.
While the puts dwindle to just $120 million, that creates a massive net favorability of $4.7 billion for the call option holders.
Okay.
So as these scenarios clearly illustrate, the closer Bitcoin gets to, and especially if it surpasses that $110,000 mark, the more the advantage dramatically shifts towards those who bet on the price going up. As the analysis underscores, this is really the territory where the bulls stand to gain the most and potentially even propel Bitcoin to a new all-time high.
Okay, so to bring it all together, we're facing this significant $13.8 billion Bitcoin options expiry on May 30th. The bulls are aiming squarely for that $110,000 target, trying to maximize the value of nearly $5 billion in call options. They're fueled by recent price gains and those substantial ETF inflows. The bears, on the other hand, might try to counter through the futures market, but their primary hope likely rests on a weakening macroeconomic picture, particularly the uncertainty around potential tariffs.
That seems right.
And as we've just walked through in these potential price scenarios, the higher Bitcoin climbs towards, and especially beyond $110,000, the greater the financial advantage for the call option holders. It becomes very one-sided.
Exactly. But it's vital to remember, however, that these scenarios are based on the current open interest data. They represent potential outcomes based on those imbalances we see right now. They don't, and really can't, account for the intricate web of individual trading strategies that sophisticated market participants might be employing behind the scenes.
Absolutely, yeah. Good point. It's a theoretical model based on the knowns. So here's maybe a thought to leave you, the listener, with. Given the sheer magnitude of money involved here, the open interest in both options and futures markets, coupled with the considerable uncertainty surrounding the global economic outlook and these potential tariffs, what do you think is the most probable trajectory for Bitcoin's price as we approach that May 30th expiry? And maybe looking beyond these established market mechanics we've discussed, what unforeseen events or wildcard factors might ultimately play the decisive role, something to mull over